options. So tell me about my options since you've asked me about my retirement planning. What is a good option to provide cash flow for my lifestyle?
Yes.
I don't want to work forever, and I probably have not saved enough money as it stands now.
So this is the second most exciting life insurance planning strategy to come along in a long time. The first one was QLS we just talked about.
Okay.
This is the second one. So, Carmen, you are a high-level executive, and you're making a nice income. Let's say you're making at least $200,000 a year.
Okay.
And you probably have $1 million of net worth. Now, if your dog got kidnapped and you had to come up with $1 million ransom, you probably couldn't do it.
Probably not.
Because it's probably in your retirement plan and it's probably equity in your home and you probably don't. Yeah. So you haven't saved enough for retirement.
Right.
What are you going to do? You only have so many years. You're limited to how much you can contribute to the IRA, 401k, even the profit sharing plans. So along comes this strategy. It's a life insurance strategy where the bank will lend you money to pay the premiums. Now, we talked about earlier what's one of the 3 good reasons for buying life insurance. It's cash accumulation.
Right.
So what if a bank would lend you the money to put into the cash value of the policy? It's called premium financing. Well, tell me a little more. That sounds good. There's got to be a catch, but that sounds pretty good. Well, if you put a lot of premium into a policy, you don't always have to buy a lot of death benefit. You can there's rules about how much money you can put into a policy and buy a very low death benefit. So that's what we do in this strategy. And in fact, we have a bank standing by that's willing to be your partner in this deal.
Wow.
So if you put in, say, $50,000 a year for 5 years, the bank will match it, $50,000 a year for 5 years. And then the next 5 years, you don't have to put in any more premiums. The bank will put in $100,000 a year for each of the next 5 years.
What does the bank get out of it?
Why would the bank do that?
Right.
Well, they're charging interest. They're charging a fair market interest rate, which, by the way, I just got a client statement yesterday. He emailed me and said, Chris, give me a quick summary of how my policy is performing. Well, we bought it in March of 2019, and it just matured in March of 2020. It's not doing so good. The market went down.
Yeah, right.
So he actually got 0 credit for the year. But I emailed him back and I said, nothing to worry about. We know we're going to have some 0 years. And by the way, your interest rate went from 4 point whatever it was down to 2.75. So he was happy about that.
Yeah, right.
So why does the bank do this, though? The bank does this because they're getting a fair market interest rate and there's no risk. Because this is not your everyday life insurance policy. When you put in $50,000 and the bank matches the $50,000 and puts $100,000 of premium in, that very next day there's $100,000 of cash value in the policy. So the bank has a collateral assignment against the cash value in the policy. If you decide you're not paying any more premiums, they take the policy back and they're fully
they're golden.
They're covered.
Right.
So the bank has very little risk. This is a company that's aggregating this arrangement with hundreds.
What's this called?
It's called Kaizen.
Oh.
KAI-ZEN. And that's just a name for this strategy, and it's a name for the group in Texas who has put all this together, the trust that owns the policies and the banks that they're selling these finance premium deals to in different tranches. But reducing the risk and doing all the management for you, it really is almost a set it and forget it.
Isn't there an Asian philosophy that's tied with Kaizen?
Yes, it has to do with continuous improvement.
That's right.
Yeah, I think it's a Japanese term that means continuous improvement. At any rate, it's not for everybody. There are risks. It's not a sure thing. But for the right circumstance, it's a way for you to turbocharge your retirement savings in a way that's not available anywhere else, because we have a bank that's going to lend you the money to fund your retirement.
Yeah,
now what happens is over a 15-year period, if everything works well, there's enough cash value in the policy to pay the bank back. So the bank's out, and you've got the benefit of all this compound growth of that money the whole time. So when you bought your house, did you pay cash or take a loan?
I paid cash and took a loan.
Yeah, you put a down payment and you have a mortgage.
Right.
So let's say you put $50,000 down and you bought a $200,000 house and you have a $150,000 mortgage. Well, over the last 20 years, has the price of that home appreciated?
Oh, absolutely.
So maybe it's worth $400,000 now.
Right.
Did the bank get any more money from the loan?
No.
You just paid down the mortgage. You kept all the rest.
Right.
So you got the benefit of that leverage. The bank lent you the money, and the asset that you bought with that money went up in value. You paid the bank back. You kept all the equity. Same idea here.
Yeah, that's great.
It's the same idea here. So for a lot of people, they can't afford to fund their retirement more. This is a really powerful strategy for doing so. And it's not without risk, because with all potential for upside, there's always some risk. But we've done everything, and not just we, the company that I'm licensed with and work with has taken gone to the end of every possibility to maximize the return and to minimize the risk on this strategy. And so it's, again, you got to get a good life insurance guy, make sure it's in line with your goals and objectives. You wouldn't do this with all of your money, but it's a really powerful strategy for the right. And normally, to do a premium finance arrangement, you have to have, at a minimum, $400,000 or $500,000 a year of income and then a $5 million net worth. And the minimums on this one are substantially less.
So I think we should actually end this podcast and go talk about this and see the details, see whether it works for me.
I happen to have.
Sign me up right now.
I have a brochure in the car. Let's
go do it.
Let's
do it.
Okay, thank you very much. This is Chris Ream, Life Insurance Guy. Shout out to Deanna Jones, who's the production engineer, and to Ryan Salazar, who built this amazing place, Broadcast Beat Studios, right here in downtown Oakland Park, Florida, where we're still on lockdown, but we're an essential business. Thank you very much.
All right, bye-bye.